Our guest for today, an old-timer from the market, a veteran of many bull and bear markets, Sanjeev Prasad of Kotak Institutional Equities. Sanjeev, great to see you again. It's an interesting time to get you on because the year has started with such a volatile fashion. Do you get the sense that this could be one of those years after 2 good years that we could even have a down year by the end of it, 2022?
It's possible. Anything is possible in markets, as you know, Udayan. See, the challenge for this year is the starting point is not that great, and you also have a lot of events on which, unfortunately, nobody has any control. So, number one is, of course, valuations are on the higher side. When you're looking at the market, which is more like 20 times FY23 earnings, so that's clearly on the higher side. And more specifically, if you look at individual stocks, many of them are well above the pre-COVID levels. So you have a risk of deteriorating in some of the names as we go forward. Now remember, when I say 20 times, that is already factoring in the very strong earnings growth both in FY22 and FY23. So for FY22, for example, for the Nifty 15 days, we are looking at about 35-36% growth in net profits. And for FY23, we are looking at another 18% on top of that. But all that good news is already priced in the form of very expensive valuations. And on the negative side, of course, bond yields have already gone up, both globally and domestically. Looks like they will head up further. And I just hope in India we don't have a repeat of what we have seen in the US in terms of the central banks suddenly making a big pivot on the whole inflation point. Right? So as of now, we're looking at inflation being somewhat soft in the second half, but that's what RBI is predicting. God forbid if inflation is on the higher side and RBI has to raise rates much faster than what the market is assuming currently, then that also could be a big negative. And don't forget, we are in the middle of a big geopolitical crisis as of now. Who knows, what's the final outcome over here? So all the base case scenario obviously assumes that there is no, further deterioration of the situation in Europe with respect to Russia, Ukraine relationships, and things calm down hopefully over a period of time. But we don't know, and the clear risk is if something goes out of hand, if Russia actually invades Ukraine, all bets are off in that case. You could see a market which has a pretty significant downward in that case. Yeah, so the setup is not very good again, I would say.
How much downside do you see in the markets, Sanjeev, in the event of this volatility continuing? Because so far we've had a correction which cannot be called deep even by a bull market correction standard, 7-8%, not much more than that. Do you think we'll get away with a cut like this, or could we be staring at something like a 20% correction, which would count as a deep correction? And in the past, in bull markets, we've had running 20% corrections. Do you fear this could be that severe a dip?
If you look at on the volatility point, day-to-day basis, depending on the news flow coming out of the US Fed or the Russia-Ukraine issue, you will have volatility in the market. But if you look at the Indian market, the last 6 months, it actually gone nowhere. It's pretty much at the same level, on a plus minus 5% basis. That's where the market has been pretty much trading. And I hope that's the case. Actually, that's not a bad outcome for the market, given where we are in terms of the starting point, as I was saying, valuation of rich. Many of the growth/quality stocks are trading at pretty rich valuations. So I think we have to go through a time correction. So that's not a bad outcome as we have been seeing in the last 6 months. A really ugly outcome could be things getting out of hand on the geopolitical side. Which means you could have a pretty serious cut in the market. Whether they go down 15 times, which is more like 25% correction from current levels, we'll have to wait and see. But if you look at the market and if you look at yield gap, which is what I focus on, currently you have 10-year G-Security about 670 basis points, 6.7%, and your earning yield is, let's say, 1 upon 20, so about 5%. So the gap is somewhere over 170 basis point. A good case situation for the market is, let's say, when the bond and earning yields are similar. But that will unfortunately only happen when the market corrects to 15 times, and from 20 to 15, that's a pretty big cut for the market. That's like an 8% cut. I hope we don't see that situation, but it's a possibility, definitely, given where we are in terms of the geopolitical issue that we are staring at, bond yields, which will definitely go up from where we are, and a lot of good news on earnings and recovery, etc., completely priced in the market.